And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the last week of June as we get ready to wrap up the month. Also the end of the quarter. Of course, big news over the weekend is the bombing of the 3 nuclear sites in Iran. We've spent some time this morning talking a little bit about what happened and, of course, what this means for markets. I was literally, pun intended, bombarded over on Sunday by emails of kind of panicked investors going, we need to get out of the markets right now, and this is terrible, and just, be calm here because, again, markets this morning are not reacting negatively. And again, there's part of this is stuff that we've already talked about. Market positioning remains off sides. It remains underweight. We're going into the end of the quarter. There's a lot of things that are kind of contributing to the markets right now, but in reality, there's just a lot of bullish sentiment, a lot of momentum to the markets, and markets are seeing very quickly through what's happening in some of these areas and things that you think should be happening because of this attack over the weekend aren't. Now, it doesn't mean that these issues won't crop up. Again, the big concern for markets right now is what happens next. Does Iran retaliate? Is the U.S. kind of a one strike and done deal, or are there more targets coming? Trump alluded to the weekend that there were many more targets left, which suggests that there's going to be more engagement at some point. We'll see. But again, as investors, the thing we have to do is step back and focus on the one thing that matters the most. And this is part of, I wrote an article yesterday. It's on the website this morning, which goes through the entire analysis. So we'll touch on some of those graphs here in a minute. But the big thing is to step back and say, what does this mean for earnings in the U.S. and economic growth? Does this attack on Iran change the earnings trajectory for U.S. companies? And that's the answer you need. Because if this attack in Iran is something that will change the earnings dynamics for Google, Meta, Apple, the whole AI thing, then that's something to be concerned about, and we need to reduce equity exposure to those areas. If it's not, then that's the other side of the coin. So this is the thing we've got to think about here over the next few days. And again, as we pay attention to headlines today, it's very early, right? Markets are just getting ready to open this morning. Last night, futures were down fairly sharply. This morning, they're up a bit. So again, markets kind of looking through this event already this weekend. But that doesn't mean that's how today's going to end. We could see the market open up this morning and then institutions come in and sell it off in the afternoon. So there's no guarantee, right, of how this market's going to react this morning or today or tomorrow or the rest of this week as we head into the end of the quarter. There's also some other outstanding things that are going to potentially weigh on the markets going into Friday, which is that we've got, again, end of the quarter rebalancing because of this massive surge. So this big surge in the market started on April the 7th. That was the beginning of the second quarter, April, May, June. So where institutions are now is because of this rally, institutions are likely overweight in equities and underweight in fixed income. So we may see some selling this week as these institutions rebalance portfolios back to target weights, and they'll have nothing to do with what's happening in Iran. So again, there's a few things that are happening this week we need to pay attention to that could lead to some selling pressure this week, no guarantee, that have nothing to do with what's happening in Iran. Now, again, our kind of immediate concerns, we'll kind of talk about what happened, this weekend and what that potentially means. But here's what you need to know before the bell this morning. We're going to run through this morning a few different areas of the markets that are being impacted potentially or historically been impacted by geopolitical military conflict. And we'll see what these are doing this morning. So let's start with the S&P 500. That's obviously the first issue up. Market futures were down fairly sharply last night. We were down immediately after the attack. We were down about 1%. Then a little while later, after things kind of sank in, futures were off about 0.5% this morning. futures are actually green right now, just a bit. We're up about 10 basis points, 11 basis points on the S&P. We'll see. But again, this is still early. So, we'll see how things look as we get closer to market open. But two things that are going on. Friday, the market sold off here a bit, and we're sitting right on the 20-day moving average. So the market continues to really kind of work through this support line here, holding that support. We're working off, and have worked off about half of the relative strength overbought condition. The momentum indicator is also is on a sell signal here and beginning to work itself off. So we're starting to work off this consolidation that we've been in now really since May the 11th is beginning to work off some of that previous overbought condition. If we get a little bit more sloppiness this week, we could actually get the markets oversold enough. Now, the month of July tends to be fairly strong for equities. That's because you're going into the second quarter. You've got earnings season, lots of support. Buybacks come back into the markets around the middle of the month. So there's a lot of reasons why July tends to be a fairly strong month. So again, there may be a decent entry point by the end of this week. If we get a little bit more selling pressure this week, we'll probably set up for a decent entry point to add some exposure going into the month of July. So we'll kind of pay attention to it this week and adjust portfolios as we need to. The other side of the coin, of course, is the dollar. And we've talked about this for a while. Friday, we published an article on the website called "The Death of the Dollar is Greatly Exaggerated." And part of what happens over this weekend, and of course what happens this week, could lead to a fairly strong pickup in the dollar. But we already saw the dollar rallying over the course of the last week because of these rising tensions between Iran and Israel, and of course the United States now. And so we're likely going to see the dollar's already moving higher this morning. So there's a huge short position on the U.S. dollar. So if this dollar begins to get traction and we get above, say, 99.100 on the U.S. dollar index, we could see a fairly sharp rally in the dollar here as those shorts are forced to cover. Again, there's an abnormally large short position on the dollar right now. So there is a good bit of upside catalyst. You've just triggered a buy signal. Relative strength is improving. So there is some underlying momentum right now building in for a dollar rally. Now, that doesn't mean the dollar is going to go off to the moon here, but you can see a fairly substantial rally to 102, 103, and that's going to weigh on assets that are traded in dollars. So, for instance, when you take what you're looking for here is assets that trade non-corollary to the dollar. So as the dollar weakens, since a lot of assets like oil and gold and other stuff trade in dollars, a stronger dollar is going to weigh potentially on dollar traded assets. So just kind of pay attention to that rally in the dollar as it relates to other assets that trade in U.S. dollars. The oil prices, of course, big concern right now is the Strait of Hormuz. If that Strait of Hormuz is closed, that potentially is a backbone for much higher oil prices. Oil prices are falling a little bit this morning. They had spiked up overnight because of this attack, but we're seeing those kind of cool off here just a little bit this morning. So a lot of the concern yesterday, particularly with the markets, was this impact of this, kind of really becoming much more widespread. It's starting to look like, and the markets are starting to think, that this is going to be just a one-time event and that's done. We're going to see, and again, there's a lot of things still unfolding here, and we'll talk about this more in a minute, but oil prices are starting to calm down here just a bit. Gold prices also had a lot of early gains yesterday because of the attack. Those are already starting to give up a big chunk of their gains this morning as well. So again, the big major concern of this military event was a much broader fallout to kind of the U.S. markets. The markets are now reversing a lot of that view, saying, okay, this is pretty much a one and done event and things are going back to more normal or more normal situation here. So again, don't overly panic this morning, in particular because of that news headline event. Let's pay attention to markets and then just navigate them from here. But that's what you need to know before the bell this morning. And we'll get back, talk more about this, the dollar, other assets here as it relates to Iran and the United States. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So last week here on the show, I was talking about next week, we won't be here. It is summer vacation. I'm leaving to go to the UK to visit my son. And I made the comment on the Thoughtful Money podcast that my wife has made arrangements for us to drive from one of our places that we're going to be to Jeremy Clarkson's new restaurant called The Farmer's Dog, because my wife loves the show Clarkson's Farm. So I got this very, nice comment from a viewer, and he says, you really don't understand the UK, because from where you're going to be in Sleaford, it's 3.5 hours to drive to this particular restaurant. Well, first of all, we're not going to be in Sleaford. That's where my son lives. We're going to be in between Lincoln and London over there. So it's technically about an hour and a half from where we're going to be to the restaurant and back. But it was just it kind of tickled me a little bit, because it takes 2.5 hours to drive from Houston to Austin. It's 4 hours to Dallas, 4.5 hours to Dallas. If you want to drive to Texas Tech in Lubbock, that's 9 hours. It's 3 hours to San Antonio, 3 hours or so to Corpus Christi, all from the Houston. And from where, look, it takes an hour to get outside of Houston, depending on where you start. So, I just thought it was just kind of tickled me, because you just don't, I understand that the UK, maybe an hour and a half drive somewhere is like a really long way. That's just a warm up in Texas. We haven't even stopped at Buc-ee's yet in an hour and a half drive in Texas. So, I mean, you're not stopping at a Buc-ee's at least 2 hours into your drive, right? Because you got to go to the restroom, whatever. So, this is how you mark, by the way, this is how you mark trips in Texas now, is the distance between Buc-ee's. So just, because they even have billboards, 106 miles to Buc-ee's, right? So, but I got tickled, because it's just, I forget that living in Texas is larger than the entire country of France. I mean, you take France, stick it inside of Texas. So UK might make up Houston. I'm not sure, but But yeah, I got tickled by that, because like an hour and a half drive for me, that's
Sunday stroll, right? That's nothing, right? We do that going to work. I was listening to traffic coming in. I was listening to traffic guy on the radio coming in. He's like, yes, the 45 southbound is 45 minutes from Woodlands to, downtown Houston. And he's like, really going smoothly this morning. And because that's an hour and a half trip easy in traffic. So, yeah. So anyway, I appreciate the email and the concern for the distance. Got it under control. This is not an issue. The bigger issue is making sure my wife drives on the correct side of the road. That will be the bigger issue as we come to this. So anyway, I will fill you in on the antics when I get back. So anyway, let's get back to work here this morning. What's really kind of fascinating to me is that the morning last year, I came in here and we had to do an emergency broadcast alert because of the Japanese yen carry trade blow up that was occurring. And markets were down 2% in the morning because of that. And that morning, immediately out of the gate, we had like 1,500 viewers on YouTube, and the number of emails of concern and comments that were being made, et cetera, were just at abnormally high levels. This morning, I kind of expected the same thing. I said I got a lot of emails yesterday about the attack on Iran, but I expected a lot more fallout. Like when I woke up this morning, I expected my inbox to just be completely flooded with emails, because that's what happened after the carry trade. And that's not the case this morning. Very normal this morning in terms of kind of email flow, comments on, social media channels. Appreciate y'all being here. There's, 500 of you here in the chat already this morning, our viewers, and I certainly appreciate that very much, but not that sense of urgency. And I think that's an important thing to think about when we're talking about what's going on, is that investors are becoming much more adept at navigating markets and starting to understand a bit more about how markets respond to certain aspects and certain events. Because we've had a lot of these events over the last 15 years in particular, just going back to the financial crisis. And we're starting to see, even though there's just a ton of videos that were put out over the weekend talking about World War III, and this is terrible for the markets, and this is going to be the kind of the end game scenario for the U.S. And I saw just tons of these kind of headlines and things, but yet this morning the markets again down. They're down slightly right now. The NASDAQ is down 35 points. Bitcoin's sitting flat-ish. It's up a little bit at 100,000. Dow's down 68 points. This is not what you would have expected on this type of news headline. And again, when I got up this morning and was looking at headlines, before I started the show this morning, futures were actually slightly positive. So, I mean, they've sold off here a little bit. S&P's down 7 points right now. That certainly, again, that's not the type of reaction that you would expect from this type of event. And that's okay, right? There's again, investors are becoming much more adept at kind of navigating some of these headlines, because again, the one thing that it matters for the markets is that how does it affect earnings? But the other side of this is that positioning in the markets is not aggressive. Retail investors have gotten pretty aggressive with market exposure, but if you take a look at consolidated equity positions across portfolio managers, you take a look at the computerized trading algorithms, the CTAs, you take a look at their positioning, take a look at the systemic kind of traders, guys that are trading very system-based programs. They're all about neutral. They're not aggressively exposed to markets. In fact, they're underweight equities more than you would expect given this rally we've had in the markets from the April lows. So there's not a lot of offside positioning. In fact, there's more positioning that needs to get into the markets right now than out from a professional basis. And that's where most of the money is. Retail investors are fine. They're overly invested right now. But again, that's a much smaller aspect to the overall market than the institutions are. And institutions are underweight. So that underweighting of equity exposure, you don't have that aggressive positioning that needs to be sold off to rebalance risk because of some type of event like this. So that's one aspect that is holding up the market here from being probably, or possibly at least, much more direly impacted this morning. Now, having said that, that doesn't mean we're out of the woods by any stretch of the imagination. There is still risk. Again, what happens next? So couple of things we've got to be paying attention to. The Strait of Hormuz, as we talked about a second ago, if Iran closes that's 6 miles of water that is a choke point for oil deliveries. Now the U.S. does not get a lot of oil from the Strait of Hormuz. Most of that goes to China. But it does potentially impact the price of oil. So if the Strait of Hormuz is closed or something else occurs, we could see a much sharper spike in energy prices. And again, oil prices have certainly risen over the past few weeks as this whole Israel-Iran kind of conflict has risen. But we're not seeing oil prices spike off to the moon by any stretch of the imagination. In fact, we touched on that in this weekend's newsletter. If you haven't read it, this weekend's Bull Bear report goes through the impact of oil prices. But my take was a little bit different there because, again, that related more to the Fed meeting. The recent Federal Reserve meeting, Jerome Powell kept saying, hey, we haven't seen any impact of tariffs, but it's coming, right? The tariff inflation is coming. And a big part of their issue is that they are so tied up in their concerns over transitory, inflation that they're now overcompensating for tariff inflation. But they're likely to be vindicated. We've had 4 straight months of inflation being much lower than expected, even though we've had tariffs. And they're likely to be vindicated now because we'll likely see an uptick in CPI because of this recent rise in oil prices. But the recent rise in oil prices is not dramatic. We're still well confined within a longer-term downtrend in oil prices back from the previous spike we had to around $100 a barrel. So, but again, if the Strait of Hormuz closes, there's certainly a scenario where we could see $80, $90, $100 barrel oil pretty quick, just over concerns of that happening. And, so that's one impact to markets. We'll certainly see it show up potentially in inflation over the next couple of months. We'll see a slightly hotter print. But oil prices is certainly something that would weigh on the U.S. economy and potentially hurt earnings because of a decline in U.S. demand if oil prices do spike. So it is something that we need to pay attention to. When we come back, we'll talk a little bit more about, the situation in Iran right now, kind of where we are, what happens next potentially, or what the concerns are, and kind of how to navigate the market from where we are right now. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife's traveling. She's in Quebec right now for work. She called me up. She goes, everybody speaks French up here. I go, yes, honey. They're a French colony. She goes, I never knew that.
The Real Investment Show podcast. Same show, your schedule.
So the company that she's with took her out to dinner last night. They go to this very nice French restaurant. The appetizer comes out, which is bagua. She goes, that's duck liver, isn't it? Yeah, the rest of the dinner was downhill right from there. So
at realinvestmentadvice.com.
And the only thing that made it better was when they brought the snails out.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So again, just talking a little bit about the World War III in Iran. If you want to know how this plays out, just watch Top Gun Maverick. All weekend was my social media feeds were just the scenes from Top Gun Maverick. Says, here's the bird's eye view of the bombing in Iran, because that was the whole premise of the movie. They were knocking out the nuclear facilities, you know, in that movie. So, but that was my whole feed this weekend. So apparently that's all you have to, if you want to know how this plays out, just watch the movie. You'll be fine.
That and snippets from games.
Yeah.
Video games. Yeah.
Yeah, exactly. So yeah, this has been played out long, you know, and importantly, this is not our first intervention with Iran, right? This whole, you know, nuclear treaty. Remember back during the Obama administration, John Kerry went and negotiated the nuclear deal, right? The deal with Iran. And in that deal, they said, okay, we're not going to enrich our uranium, wink, wink, nudge, nudge, and you give us $150 billion in cash on pallets brought over by midnight, you know, in planes, and release some of your hostages to us. And, you know, that was supposed to solve the whole problem. Of course, that's Iran's game, right? Iran has always been the better negotiator at this. Like, oh yeah, we'll do this. And then behind the scenes, they just keep doing what they're doing to, you know, build their nuclear program. And so this is not the first time that we've been in this situation. You go back to this is not the first time that there's been conflict between Iran and the U.S. of any sort. This has been going on since the 1980s. So, this is not new to markets, what's going on right now. The big concern, of course, over the weekend is that this is the event, right? And this has always been the concern, is that every time something happens, like, oh, this is going to start World War III, and it doesn't. These things calm down in fairly short order, and everything kind of goes back to status quo. Everybody gets back on their side of the fence and, goes back to doing what they're doing. And this isn't, this isn't going to stop Iran from building nuclear facilities or nuclear capability. It's going to set them back, obviously. But the next time they do this, they'll just build the bunker deeper, fortify it better to avoid bunker buster bombs, right? I mean, this is going to set them back a decade or so, but we're going to be back in the situation with Iran at some point in the future. That's just the nature of how this is going to work out. So again, what we have to do as investors is to step back and go, what does this actually mean? And again, there's the one contingent of people in the media that are spinning this to be the worst possible outcomes. This is the beginning of World War III. This is going to be this, that, or the other thing. That's probably not the case. And again, if we put things on a bell curve distribution of what is most likely to happen versus the outliers, what happens in the middle is the probable outcomes of this situation. And so what's on the tail risk events, right? What could happen but are very remote possibilities. World War III, complete peace, right? Those are your two kind of outliers. We're never going to have complete peace with Iran. They're not going to fall in line and just say, okay, we give up. That's not them. On the other side, they also don't want World War III. They don't have the capability to fight it. So the reality is the vast majority of probabilities lie somewhere in middle ground that, this is potentially a very limited event, and there will be some retaliation, and then that'll be it. The other probability is that this incurs more strikes. Things heat up a bit before they cool down. This will pass. The only question is how contentious does it get before negotiations occur and everybody goes back to the table? Because eventually that's where this ends up. This ends up back with everybody sitting down at the table and negotiating a new treaty for whatever it is. That's where this likely ends up. That's the high probability of that. The question is just simply the timing and what happens between now and when that event occurs. And how does that impact the markets? And again, the most likely impacts to markets are going to be higher oil prices, a strong dollar, and potentially weaker equity markets. That's what history tells us. But that doesn't mean dramatically weaker equity prices. Again, if we kind of go back in history, and we did this last week as well. So I wrote an article last Monday about Iran and Israel and kind of went through some of the analysis of what happens historically. And I posted in this table. This table is previous events going back to 1940. And sorry, my graph changed here. So this goes back to 1940, and generally markets wind up higher over the coming months. Now, there's certainly a few outliers in there where you had bigger equity declines. For instance, like the USS Cole bombing. That bombing occurred in the middle of the dot-com crisis. So the decline had much less to do with the USS Cole bombing than it did with the unraveling of massive amounts of speculation in the financial markets. We talked about this last Monday. So again, you've got to make sure that you not only take the event when you're doing this analysis, but apply that event to what else was happening within the markets. But more often than not, equity prices wind up higher over the course of the next 12 months than not. And that's because a lot of these events, as I was saying earlier, have nothing to do with earnings in the U.S. And again, this is the important concept to understand when you're thinking about these events and you're trying to focus on what's going to be the impact. You know, this is obviously very unnerving, right? And as an equity investor, it's one of those big levels of uncertainty. Like, what does this mean? But the thing to step back is, okay, this happened, right? The U.S. bombed nuclear facilities in Iran. How does that impact the earnings of the companies that I own? So if you own, for instance, defense stocks, Raytheon, Lockheed Martin, etc., that event potentially benefits those companies. It improves their earnings. Companies that you may own like Royal Caribbean or airline stocks of companies that particularly have routes that go to Israel and Iran and those type of things, right? There's going to be less people wanting to go there right now. So those stocks will likely experience a reduction of earnings because of this event. What does this event have to do with NVIDIA, Apple, Microsoft, Google in terms of their earnings and the whole AI build-out infrastructure issue? How does this event affect those companies? This is the exercise that you need to do with your portfolio. Now, if you're just buying an index, a passive ETF, and your portfolio is just, I'm long S&P 500 index, I'm long, various ETFs, then you need to think about just the more kind of global macro impact. In the short term, maybe some negative events to the overall market. Long term, probably not. But this is the exercise we need to step through. How does this event affect the one thing that drives the markets more than anything else, which is how do investors today value the market based on forward earnings expectations? Does this event change forward earnings expectations to a great degree, or to a degree enough that investors need to revalue what they're willing to pay for an S&P 500 index? That's the exercise we need to work on. Now, historically, and again, this is a chart of the S&P going back to 1900, actually 1871, with events labeled on it. And again, there's certainly short-term impacts. I mean, you can look at when the Libya bombing or, the intervention into Lebanon and the Panama invasion, and certainly look at there and say, yeah, there were certainly some short-term clips to the markets. But again, as longer-term investors, what did that mean? And again, you have to take some of these things and put them into context. For instance, like the Vietnam War certainly had some market drawdowns along the way until we got to 73, 74, where you had a very large market drawdown. Black bear market was called back then. But that didn't really have anything to do with Vietnam. That was the popping of the Nifty 50 bubble. And we had surging oil prices because of the oil embargo, et cetera. So there were other impacts that caused that much bigger drawdown in the market. It really wasn't the Vietnam War. So again, it's always important to put these things into context and keep perspective and kind of understanding the interplay. But what this all comes down to at the end of the day is how does it affect earnings? All right, come back. We're ready to wrap up the show. Don't go away.
investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. Realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Headline this morning, breaking news, U.S. enters a war between Israel and Iran. One of the comments that I made in our article that's out this morning talking about the bombing over the weekend of the nuclear facilities is that CNBC's headlines would be bright red this morning with scare you to death type headlines. Markets in turmoil, but markets really aren't in turmoil, so that's kind of problematic for the headline. But futures are down a little bit this morning, and that's what you would expect. But again, they were green before I got on the show. So just here in the last few minutes, as traders are getting ready to open the markets for the day, we're starting to see a little bit of a sell-off. Dow's down about 100 points right now. Nasdaq's around down about 70 points. The S&P's down about 10 points at the moment. So again, we just dropped bombs on nuclear facilities in Iran. This is the one thing that everybody was afraid of, and yet markets are barely reacting to it this morning. And that says a lot about markets right now. There's a lot of momentum in the markets, and investors are very optimistic. We've seen, Friday is a good example, was the largest options expiration day or expiration June in history. You had $5.9 trillion worth of options expire on Friday. So some of today's action is just the follow through from Friday's options expiration. People, having to either, sell, cover, margin, et cetera this morning. So part of this kind of issue this morning is related to that. But again, some of it, not unsurprisingly, is due to the news headline. Again, it's uncertainty and it's scary, right? I mean, Iran has always been that area of the Middle East that nobody wants to mess with. And they, obviously there has been headlines recently from Russia saying don't mess with Iran. Iran's allies are China, Russia, and North Korea. So, obviously they've got some buddies that, we don't necessarily want to mess with either. So it's certainly scary, and I get that. The question, of course, and again, there's a lot of unknowns about what happens next, but the thing for investors is not to overcompensate or overanalyze or over-extrapolate this event. Yes, there are certainly some very bad things that could come out of this. We could see a very sharp rise in oil prices. We could see a very sharp rise in the dollar. That would be historical norms of what happens with these type of conflicts. That would have impacts on the U.S. economy. We could see much lower equity prices, another norm for this type of event. Now, we're not talking about a crash, not a financial crisis, but we could see lower equity prices because of this. 5-10% correction, not outside the norm. If this does begin to gain some traction. But right now, we're not there yet. So it's important for us to pay attention to what's happening with the markets, where those important support lines are. Look, we've been talking about for the last 3 weeks here on the show that the market was due for a short-term correction of some sort. And markets were overbought. We were on a sell signal. Markets needed to pull back here a bit. And, this would not be surprising. But again, as is always the case, in order to have some type of corrective action or pullback to some degree, you're going to need some type of event to occur that causes that type of selling. And we just haven't really had much of that as of late. And so when you kind of take a look at where the market is, the markets have come off their peak here a little bit. We're working off some of that previous overbought condition, but markets really haven't pulled back a lot at all. And so this could certainly lead to a bit of a deeper correction. But again, for the most part, the market's trading just fine. It's acting very normally. And despite, the headline news, we're sitting on support, trying to hold that. Now, we may take out the 20-day moving average today, and that kind of sets us up for a bit of a decline to the 200-day moving average, which is sitting right below the 20-day. So there's certainly an event here that could lead to a bit of a 2-3% sell-off in the markets over the course of this week, depending on what happens. Do we get more rhetoric out of the White House about more targets that are coming, or are there more strikes, overnight in the next 24 to 48 hours on other targets in Iran? Does Iran close the Strait of Hormuz? If they do, that's potentially spike in oil prices. That's going to potentially impact markets. A lot of things can happen here. So there's certainly nothing wrong with, if you are heavily exposed to equities, there's nothing wrong with stepping in right now, taking some profits, rebalancing your risk, raising a little bit of cash levels. We're holding about 20% cash in our portfolios right now, just kind of waiting for the right opportunity to deploy that cash. And so right now we've got a decent hedge against this event in our portfolios right now. Of course, we're also long treasuries, which would benefit from this as well. So we're certainly in an okay position right now to weather this phase out, and hopefully we do get a little bit of a better entry point to put some cash to work. But again, if you've got a lot of long risk, there is uncertainty here. I'm not saying don't worry about this, everything's fine. I'm not saying that at all. I am saying that historically speaking, these events tend to be short-lived. And what I don't want you to do is to extrapolate this out into being the beginning of World War III. And, oh my gosh, you better have, beanie weenies in your bunker all set up, ready to go, because this is the end times as we know it. That's a very, very low probability event. The bigger probability is that this will pass and we will move on at some point in the future, but the timing of that is unknown. So in the meantime, we could certainly see a pickup in volatility depending on what events come next. And look, Iran is not going to sit there and just take it. You can almost bet your bottom dollar on that. And there's going to be retaliation in some form. What that is, don't know. Tom Homan, head of border security, was talking about over the weekend that there's potentially a lot of Iranian immigrants in the U.S. that could be sleeper cells for Iran. We could see some terrorist activities here in retaliation. I'm just repeating headlines. Certainly concerning, right? But certainly have an impact on the markets. for sure. But again, we don't know these things. So again, being a little bit more cautious here certainly makes some sense, but I wouldn't go entirely overboard and go 100% cash. I'm out of equities. I'm, just, long, gold or oil or whatever it is. I wouldn't make a one-sided bet on this. That typically tends to not work out well, because in most cases, the most dire outcome never comes to fruition. It's always some other outcome. And most likely this will resolve itself. There will be negotiations. There will be, conversations held, backdoor channels, etc., and start working through, this type of situation. Again, we don't know. I don't know. I don't know how this turns out. Just going to have to navigate it the best we can. But again, we've got about 20% cash. We're holding bonds. We've got equities that will participate because of this event, companies like Raytheon, et cetera. Other companies that aren't affected by this will continue to do well. But again, just things to kind of focus on. This is the problem for most investors is overreacting. And what we want to do is be logical about our approach to managing your portfolio, your money, your investments in this type of environment because of simply the unknowns that are occurring. And again, one of the, we talk a lot here about emotional biases, about behaviors. This is where one of the most egregious behaviors shows up in investors, which is loss avoidance. I don't want to lose money. I sell everything. Those are the traps that impair our ability to make money over time. And again, volatility is part of the market. We need to understand that when these events occur, it's going to cause volatility. And when volatility occurs, and i.e. we get lower prices, we want to be buyers, not sellers. And again, we've been talking about now for the last 3-4 weeks, market's overbought. We're going to have a correction consolidation. We get to support. We can put some capital to work. This is that event we were talking about. We never know what the event's going to be, right? But there's always an event that occurs that leads to lower prices and provides a better entry opportunity to put capital to work. But if you haven't taken profits, and if you haven't rebalanced portfolios, if you haven't raised some cash levels in your portfolio when markets are overbought, you can't buy when markets are oversold. And we're starting to work our way towards those oversold levels that will give us a better entry opportunity to buy stocks that you want. And we've got a nice little shopping list of companies we want to add to our portfolio, rebalance, but they're just really grossly overbought right now. They'll eventually pull back. And when they do, we want to be buyers of those companies at cheaper prices. And that's the one thing that historically tends to bypass investors is they get so wrapped up in chasing whatever stock. Oklo, as an example, has been kind of the retail trader's dream as of late, right? Stock's had a huge run. If you buy it here, odds are you're going to wind up losing money before you make money because you're buying it over when it's already overbought and extended. So navigate the markets, manage your emotions, step back, analyze the markets, what's going on today, pay attention to what this means for earnings, because that's the only thing that matters. Earnings and valuations, all that matters at the end of the day. How does this impact that? Certainly, manage your risk. And if you're really worried about this, raise a little bit of cash. Don't sell everything, but just raise a little bit of cash here so you can sleep better at night until this is over. All right, have a great day. We'll see you back here tomorrow. Bring up the latest news of what happens today with the markets. We'll cover that tomorrow with John Penn. Have a great day.